Hi, everybody. Thanks for making it to our Tricio webinar. Today's topic is going to be housing and the economy. John Calverley is going to be speaking about the housing outlook for the US, UK, and other parts of the world. And we'll also be looking at the US economy and UK economy as well. Per usual, we will spend some time discussing all of this and leave some minutes at the end for questions if you have them. Now, as you guys know, John Calverley is Tricio's chief economist. I've been working with him proudly since 1996, and he's been doing all sorts of studies and research in the global economy since well before that. He is what I would consider to be an expert on the housing cycle. He's written a few books about bubbles, and he's spoken extensively about what goes on in terms of the cyclical aspects of housing booms, busts, and how everything interplays into what makes house prices go up or go down. And so without further ado, it's my pleasure to say, John, take it away.
Thanks, Jerry. Thanks, Jerry, for the kind introduction. The agenda today is to look at trends in house prices. So I'll show you some charts of the major countries, talk about what's driving them, then talk about some of the economic implications of what's happening in the housing sector, and then talk about the investment implications. And we'll come back to Jerry at the end just to look at some of the home builder stocks. So this picture is nominal house prices for Canada, US, and the UK. I'm going right back to 1971. I've set 2010 equal to 100. That was really the end of the collapse after the 2008 crisis. You can see that Canada went up the most, and it's come down a bit since, but most recently it's actually started to go up again. You can see the UK went up pretty much in line with the US during this cycle, except at the end when the US outperformed, and UK prices are falling a bit now, whereas the US, having fallen just a little bit in last year, actually rising again now. And what I've done here is I'm using real house prices from the Bank for International Settlements. So this is taking into account ordinary consumer price inflation. I like to look at this because I think it also shows the house price cycle. I think there is a 16 to 18 year house price cycle. You see it pretty clearly in the UK there, peaks in 1974, 1990, 2006, and again 2022. Fairly clear, I would say, in the US and even in Canada as well. So one of the reasons we were expecting house prices to fall, we published a focus on this last year, is precisely because we were 16 years on from the last peak. Just quickly on Europe, again, 2010 equals 100. You can see how much German house prices rose in the last decade. That did become quite a big political issue, very unpopular. France, some, but not nearly as much, and Italy lagging. It's just historical, I suppose, but if you look back in the early 2000s, you see how Italy and France prices rose quite strongly then. And that was really the effects of the euro, joining the euro and having lower interest rates. But once we got to the 2008 crisis, that effect went away, and Italy's been languishing since then. If we look at the next slide, which is real house prices for those countries, so there you see it perhaps even more clearly. You see the big rise in France in the early 2000s in real house prices, also in Italy. Not in Germany, prices went actually down. And it is quite interesting if you take the long-term view. If you look at Germany and Italy, they're about the same level in real terms as they were 30 or 40 years ago. Just extraordinary, really. So even though people were complaining in Germany that house prices were rising, they're actually rising back up for a long time, just rising back up to where they'd been back in the 70s and 80s in real terms. So what's driving house prices? Well, by the end of 2021, they were historically expensive. Looking at the real house price charts I showed you, but we've also got loads of charts on house prices to rents, house prices to incomes, and they were all expensive. In the US and the UK, we were back to the 2007 peaks on many of these measures. Canada was at a new high. And then we did see a very rapid run-up in many countries during COVID and immediately after it, especially in the US. You had prices rising 35, 40% in just about 2 years, extraordinary run-up. That, of course, is quite typical of the end stage of a cycle. Another reason why we expected a peak. So, as I said before, we're due for a turn down from 2022. And of course, what's happening now? Rising rates, no secret of that. So mortgage rates going up. What we have seen, though, is that both demand and supply have been quite low. So demand is down because of rising rates. People don't want to buy when mortgage rates are higher. But supply has been held down too. And that's partly a structural thing. We just haven't seen the big house building boom that we saw in the early 2000s. And it's partly that in the last year or two, new supply has slowed down. The US cut house building, housing starts, so has the UK. The other thing that I think is not driving house prices at the moment is we haven't actually got a recession. People have been forecasting a recession for a long time. Maybe Germany, technical recession. The UK is just about positive. And the US, of course, has been growing very, very fast. Q3 GDP will be announced shortly. Looks like being 5%, potentially 5%, according to nowcasts. So US economy pretty strong. I mean, to get house prices falling a lot, you probably need to have a recession. Here's the mortgage rate, 30-year mortgage rate. Shot up in 2022, came off a bit last year, and we started to see the housing market pick up. It looked like housing starts were stabilizing. Prices actually started to rise. We've had another step up in the last few months, really, from about 6.5 to 7.5. And that's probably going to weigh on housing a little bit going forward. Of course, the other countries have also seen big rises in mortgage rates. They're mostly linked to shorter term rates, 1 to 5 years, those sorts of terms. So what's happening there is in a lot of places, consumers are increasingly having to refix at much higher rates, and that's bearing down on their economies. So why is the US diverging? I mean, it fell slightly and then now it's up, whereas in other countries we've seen a much bigger fall, and in Europe we're still seeing declines in house prices. Well, I guess I've given you the answer to some extent already. The economy is strong, unemployment is still very, very low, more jobs all the time. And then people are not moving because that way they keep their low mortgage rate from a couple of years ago. So that means there's very little supply of existing homes. And there's enough people wanting to move into new homes. And of course, the house builders are providing them with cheap rate mortgages as part of the deal. That doesn't look too bad. So that's keeping the supply and demand for new homes and for homes generally reasonably well in balance. And there has been a lack of supply over the last 10 years. This is housing starts. The sort of jaggedy line is just the actual number. It's in millions. And the smooth line is a 10-year moving average. So, of course, there was overbuilding during the 2003 to 6 period. You can see starts went up to 2 million and more. That was more than the US needed. But since then, it collapsed, and we were down at 500,000 for several years, and then only coming up rather slowly. So if you look at the 10-year moving average, it's been below about 1.3 million houses for the last 15 years or more. That is really not building enough homes. And that, I think, is why you can see that house building there came down, and it looks like it's stabilizing recently, although a bit volatile. Obviously, what drives home builders is their inventory position. So this is new home inventories to sales, and you can see they were very high in 2022. They've come down because they've sold enough and they've reduced supply. Still a little bit elevated, but they don't look too bad. So as I said, with rising mortgage rates now, we may well see a little bit more of a fallback in housing starts and perhaps in prices, but maybe not all that much. So turning to the UK, and this is the Royal Institute of Chartered Surveyors, house price expectations are weak. And I would say most people are forecasting 5 to 10% fall in prices from here. We're already down a bit, depending on which index you look at. Obviously, the economy is weaker than the US, barely moving, really. Unemployment has also started to rise a bit, not very much yet, but it has risen, unlike the US or the Eurozone. Another thing going on in the UK is that the government made it more difficult for people to rent out properties in various ways. They changed the tax regime. They added to the stamp duty when you purchase an investment property. They've changed the regulations around looking after tenants. There's a bill going through at the moment which would change that further. And of course, the Labour Party has plans to increase tenants' rights as well. So all of that is meaning that there's a net selling now of buy-to-let properties. And that's having the effect that you would expect. That's sending prices down and rents up. How that'll play politically will be interesting, but exactly what you would expect. So in the UK, all those reasons, I think we're going to see a further fall in prices. So let me summarize the outlook. First of all, let me say that I don't expect house prices to fall all that much. And the reason for that is that we've got this high inflation and high wage growth. It's a little bit like the 1970s. In the 1970s, there was a huge collapse in the housing market, but you really didn't see it because it was hidden by inflation. But if you looked at real house prices, they were down very, very strongly. So we've got underlying wage growth in the UK is up about 22% in the 3 years, 2021 to 2023. And probably next year, wage growth is going to be 4 or 5% or more again, relatively high. So this is really providing a cushion. A bit less in the US, but still a significant cushion that will support house prices. I think that the US is unlikely to fall much, if at all, unless there is a recession. I'll come back to whether there's going to be one in a moment. I just think that the lack of supply over the long run means that it's more likely to be supported. But in the UK and Europe, I think we will see some weakness coming really from the stagnation or possibly a recession, rising unemployment in particular. Now, the risks to house prices always come from recession, from higher rates, or worse of all, a combination of both. So it's going to depend on what happens, really, in terms of whether we see a recession and whether interest rates go up still higher from here. So I want to look at this question of whether the US is likely to see a recession. And I think for a number of reasons, it is less likely now than I thought a few months ago. And this is one of the reasons. You know, when you get a recession in the US, house building is usually a key swing factor. It goes from supporting the economy, 0.25% each quarter in terms of growth, to actually being quite a big negative, usually. But you can see we've already had that. We already had about a minus 1% hit to GDP in 2022. The last two quarters, there's been much less of a hit, just a small one. Obviously, we'll get the third quarter number soon. I don't think that'll be a big hit either. So you've already had that correction. Unless house building goes down again to a new low, then that is not going to contribute to a recession. So these are the reasons why I think a US recession looks less likely now. I've already given you the top one, that house building's already been through this correction. Next one is that inflation is falling nicely. That was the title of our last quarterly publication. The latest CPI number coming out of the US worried the markets a bit, because although the year-on-year core CPI was down as expected, if you looked at the 1 month or the 3 month, it was a little bit stronger. So that had the markets a bit nervous. But if you look at the longer term trend, and if you look at wage growth, I think that inflation is coming down. And that really gives the Fed time to be cautious, to not have to jump on the economy. Third reason is that we are seeing the economy withstanding high rates better than expected. I think if you'd said to people 2 or 3 years ago, what will the US economy look like if we get 5% short rates and 5% bond yields, they would have said, well, that's obviously going to cause a huge recession. But now that's where we are, and most people don't think it is. So it is withstanding high rates better than expected. People do seem to have let go of the idea that rates are going to be very low over the longer term. So I think that's important. Profitability is still high. Now, typically, one of the triggers for recession is that you get profitability falling, and then firms react to that by cutting hiring, sometimes cutting investment, and so on. But I'll show you a chart on it in just a moment. But basically, profitability is still pretty high in the US. And finally, inventories are not excessive. Now, we started to worry about this earlier this year, because inventory sales ratios across wholesale, retail, excluding auto, and also manufacturing were rising quite fast. It looked as though firms were not on top of it. And that changed over the summer. The latest data show that they have got on top of that, and inventory sales ratios have been stabilized, and they're not at particularly high levels, and auto inventories are still very low. So we now have the view that there's still a 40% chance of the US recession over the next 18 months, but the most likely is that we will see a slowdown without a recession. Here's inflation. So you can see US coming down. It's come down more than in the UK and Eurozone. Got to about 6.5, and now it's just over 4. Eurozone's also come down, and the UK has come down a bit, but not all that much, not very convincingly yet. And people are certainly worried about UK wage growth as well. So the picture is a bit mixed. The US started to fall before the other countries, I think about 6 months earlier, 6 to 9 months earlier. And I think you can also say it went up. Inflation went up before the others. So US is kind of leading this. There's a question mark as to how well it's going to come down in the Eurozone and the UK, but definitely coming down in the US. Here's the wage growth in the US. There's lots of different indicators. This is the Atlanta Fed wage tracker, which basically looks at the same people from 1 year to the next based on census data. And you can see that wage growth has slowed quite nicely, despite unemployment being very low, despite the labor market being still pretty tight. Not as tight as it was, but it's still historically relatively tight, and yet wage growth is coming down. So that suggests that firms are basically pulling down wage growth. They're not paying excessive wages. That needs to come down some more. It needs to come down probably another 1.5 percentage points, back to 4% or just below, but it's on the right track. I mentioned profits are still fairly high. So this is profits as a percent of GDP. This is for the whole economy, not just for the S&P. And you can see that the level now is similar to the level in the 2010s, which is quite high historically, around 10%. It was higher still in 2021. I think what was going on there was after COVID, there was massive demand for everything. Margins were high. There was very little discounting. Firms were able to basically charge what they wanted. And we got back to a more normal market now. But it still leaves profits pretty high. They haven't really fallen to levels or really started to fall to levels that would be a concern. And in fact, the most recent outlook is that they are actually picking up again. That's certainly true for the S&P 500 earnings. We'll find out about the economy as a whole. I guess probably in November, I think we get the profit numbers. I do think, though, that we're going to see a slowdown. You know, it hasn't happened. Obviously, Q3 is looking really strong. I think what's been driving that is particularly consumer spending. The excess savings, this chart shows household deposits as a percent of GDP, and they've come down, but they're still not back to the levels we saw pre-COVID. There's various studies on this. The Fed had a study which said that they are now back to normal levels. Other people said maybe not. There's no reason to expect that US consumers would have a particularly high savings rate at the moment. In other words, they don't need to keep lots of savings. They can spend them because unemployment's very low, house prices are strong, the stock market is kind of holding up. It certainly hasn't collapsed, at least yet. So the balance sheets of consumers are pretty good. There's no real reason why they should have a lot of precautionary savings. So exactly when this is going to run out, I'm thinking early next year, not so long now, but that I think will have an effect. It's already happened for lower income Americans. They've already run out of savings and they've jacked back up their borrowings on credit cards, for example. But better off people still have quite a lot of savings and are spending. And the other reason, of course, is that rate hikes increasingly bite. We don't know exactly how long it takes for the rate hikes to come through, but many of the hikes that we had earlier this year will still be working through. And of course, at the long end, we've seen a significant increase in the last few months, which is also going to have an impact. So all these things, it's likely to have an impact on the economy as we go forward. So here's bond yields, no real surprise. Highest level since 2009. A lot of it is real interest rates, which are up at about 2.5% now for the 10-year US tip. So people are not expecting high inflation particularly. They are expecting higher for longer, which is the Fed has been talking about for some time. So that's holding bond yields up. For a lot of people, this looks attractive, but then again, if you bought a few months ago, then it's you're underwater now. So this is something people are watching very, very closely. So here's the cyclically adjusted price earnings ratios from Robert Shiller. Got to very high levels in the US during 2021, fell in 2022 substantially, as you can see, then rose again earlier this year and have fallen back recently. So if you just look at where we are now on the far right and sort of eyeball across, it's relatively high, I would say. It's similar to where we were pre-COVID, but of course interest rates were lower then, so you take that into account. And it's higher than most of the time in the early 2000s or back in the 80s and early 90s. Not nearly as high as in 2000 during the bubble, and not nearly as high as in 2021. But it does look relatively expensive, I would say, on the high end there. In contrast, if you look at the Eurozone and the UK and just eyeball across, these are not wildly cheap levels, but they look sort of average-ish for the long term there. But the UK is down at about 15 on the cyclically adjusted, and Europe's about 18, I think now. So those don't look so exposed and look more like the average of recent years. So as I said before, obviously bond yields have risen. And so you would expect that would have an impact on equity valuations. So what this chart does, a little bit complicated, but it takes the CAPE equity yield and then subtracts the real bond yield. So, for example, if you've got an equity yield on the CAPE of 33, if you've got a price earnings ratio of 33, then you're going to have a yield of 3%. And then if you subtract the real yield of 2.5%, you've got an actual excess CAPE yield of 0.5%. That's not exactly the number we have here because of the way it's calculated, and also because the CAPE is not as high as 33. So it makes a difference. But what I would point out here is that stocks in relation to bond yields are as expensive as they've been really anytime in the last 20 years. As expensive, not more expensive, but as expensive. They're not nearly as expensive as in 2000 during the bubble, nor back in the Nifty 50 days or the early 60s, when you had also a very, very strong equity market. So yeah, they look a little bit expensive on this, but they're not wildly crazy like they were in 2000 or in 1970. And that's over to Jerry.
Thank you, John. That was really interesting. I'm just going to talk about two slides, and I'm going to try to explain what's going on. The first slide is basically it's an ETF that covers the U.S. Home construction industry, ITB. And as you can see, it had a really great run, and then COVID hit. Then we bounced back sharply after COVID. John talked about this before in terms of the recovery. And 2022 was pretty horrible. Then the amazing thing that happened at the start of this year, at the end of 2022, was that not only did the tech shares do very, very well, but you also had the home builders or home construction shares do very well as well. On the back of this, there was the news that Warren Buffett had gotten involved in the home construction industry as well. So it's one of those things where positive sentiment seemed to just swell up, and you could see all the reasons for it, as John has discussed. However, since then, we've had a pullback. Now, we were up 25% as of 2 days ago. Now we're only up 22% year to date, because this particular industry is basically seeing money come out of it, it seems. When I was talking with John about this over the last few weeks, we both agreed that, yes, on the longer term view, this is a sector you want to be involved in. But in the near term, there's still plenty of room for correction, it seems, as home builders come under a little bit of pressure. So our underlying view is, yes, you still want to be involved here, but you could see a bit of a hit, as John has said, high yields, and a bit of economic uncertainty, and you might see some of the froth continue to be taken out of the market, and maybe see another 5% to 10% off, where maybe some people might start getting back into it again. Now, the UK side of the picture is a bit different, and the reason for this is you have, as John said, slightly softer economy, and the UK home building industry is a little bit more, I would say, under pressure, because you have a lot of different factors coming through here, including, I think, some of the things that John has mentioned in terms of some of the changes in laws and stuff. You see the big blue line was Persimmon, or is Persimmon, and they've come under huge pressure because, one, they had to cut their dividends, two, they're not giving exactly the best rosy outlooks you'd ever want to see from a company you're buying into. So it's the one that's down year to date. The other of the big four were still up slightly this year, but they may come under pressure. So our underlying view for the next 6 months to a year is you may want to see further negative pressure on the shares before you step into them, because of all the things that John has talked about. But this just gives you an overall view. There are some interesting market sectors to participate in. We would be cautious about stepping in boldly right now because of all the things that we've said. And there may be just a bit more of a pullback as some of the froth that built up in the US and some of the negative pressures in the UK work through. Okay, that's it for me, John. And thank you for everybody for listening in on this. However, I do have some questions from James that I need to put to you, John, if that's okay.
Okay. Yep.
Now, I'm going to give you all the questions now, and you can answer them one by one. Is that fair?
Okay.
Okay. The first one is China. That's one thing you didn't talk about, and yet the property sector there seems to be negatively affecting sentiment, not only in the Chinese market, but now and then it leaks over into other markets as well, as sentiment does in the investment world. The next questions are, and this is going to be a tough one, you've got the ECB next week, then you've got the Fed, then you've got the Bank of England. What are they going to do? More importantly, even if they all skip the raising rates at this meeting, are they done with their rate hikes? And that's it for the questions, John. Thank you.
Okay. Well, let's take China first. Excuse me. It's if you're looking at interactions between housing and the economy, I think China is probably a fairly extreme case, because, of course, it had this massive house building boom over the 2010s. And that's basically ending in a big bust at the moment. So we saw Evergrande in trouble a couple of years ago, and it's still working its way through. And now we've got Country Garden missing payments. As soon as Country Garden missed a payment in August, that was the end, really, because the way the system works in China is that the developers take in deposits and start building using that money. They also then typically actually require people who put deposits down to take out mortgages even before they've taken delivery. And again, the house builder takes that money as well and uses it for building. So if people know that the developer is in trouble, they're simply not going to order a house. They're not going to put a deposit down or go forward. So cash flows are just leaking like crazy, and they're really stuffed, frankly. So what that's doing is that people in China are now very reluctant to buy property. They can see that they might not get the property. They can see they might lose money. In some cases, they put down deposits and they haven't got the money back. They worry that even if they use a developer which hasn't gone bust yet, that it will go bust. So the new purchases are right down. They tend to be concentrated in government-owned developers mainly, and the whole housing sector is basically in disarray. And there were various estimates that this was probably about a quarter of the economy, something like that, 25% of the economy. Some people said it was more. So if you've got housing weak, that means you don't need as much glass and steel and cement and all the rest of it. So that's feeding back into the heavy industry sector. But it's also having a wealth effect on consumers because house prices are down. So many people have bought houses as an investment, or rather flats. And they now don't think that it's going to be worth as much as what they paid for it. So they're losing money on it. Also, another way that developers got in money was using so-called wealth management products, which was basically offering 10% or so in return for cash, and then they use that to help them to build. Well, of course, those products are now in trouble as well, for people losing money on those. So you've got a wealth effect, and nobody wants to buy houses anymore, and that's really dragging on the economy. What's keeping the Chinese economy still moving, and the data's actually picked up a little bit in the last couple of months, and the GDP this week wasn't too bad, looking like they may hit their 5% forecast for the year. What's helping is that post-COVID, consumer confidence generally has been rather slowly coming back, but it is coming back. And another factor is that the government has put in place some more fiscal stimulus, not on a huge scale, but enough to get investment infrastructure moving forward a bit. So I think the housing cycle in China still has further to go. It's kind of a mixed picture, because if you were to look at Shanghai or Beijing, it's not too bad. It tends to be the smaller cities. They're still large, often 10 million people or more, rather than the mega cities that are struggling. And there's a lot of those 10 million cities. So I think house building is going to continue to drag on the economy. It's going to continue to keep things slow. But actually, China may actually look a little bit better going into next year, I think, on a cyclical basis. Its real problem is that structurally its growth is slowed. It used to grow at 10% or more recently at 6%. I think 3 or 4% is probably the rate going forward. So that's China. On the Western central banks, I wouldn't be surprised if we see no moves this time, this round. Obviously what's going on in the Middle East may temper their willingness to go forward. In the US, we know that the rise in bond yields is factoring into their thinking, and we've seen rises in bond yields in Europe, obviously, as well. So they'll be taking note of that. In Europe, I didn't really talk about it, but when you look at European inflation, of course, it's too high. Europe's story, though, is a bit different, because throughout the 2010s, they had inflation that was too low. They had inflation of 1%. They were desperately trying to push it up. So I think the ECB is very reluctant to overshoot on the downside. I think the Fed is more willing to do that. So I think that also makes the ECB a bit cautious. It's probably the Bank of England that's the most likely to raise rates another quarter of the three. And I suspect we're very near the peak everywhere now. We may see one more rise in the US. We'll probably see one more in the UK, maybe two. But I suspect we're going to be near the end. For that view to be right, though, we need to see the US slowing down. Because if the US slows down, that will affect the rest of the world as well. And so far, we're not seeing that. So if the US growth continues at this strong level, then rates could go still higher. But that's not really what I'm expecting.
Thank you, John. Just as follow-up question for me, if that's okay. You mentioned U.S. Q3 GDP and the Atlanta Fed nowcast of 5.4, I think, which is astoundingly high. And you just said about U.S. growth having to come off, and it's going to be a tug of war thing. Just for the very, very short, I know we've talked about the housing on an 18-year cycle, 16 to 18-year cycle. For the very, very short thing for this week, John, if U.S. GDP does come above, let's say, 3.5 as a number, do you think the market's going to react the way they did to retail sales this week, which is basically dump bonds and dump stocks?
That's a good question.
That's a nervous question.
Yes, yes. I mean, there is this sort of general sort of nervousness, I think, at the moment among the investment community because bond yields have gone up so much and stocks really haven't fallen very much. It's a different picture. If you took out the top tech stocks in the US and looked at the rest of the market, and if you look at the smaller stocks, they're down. So it's not quite. I mean, if you just look at the S&P, it looks like it's holding up really well. But as I say, it's not quite as good as that. But that's, I think, a concern for a lot of investors and wondering whether they should rotate out of stocks at the moment into bonds or even into cash for now, see what's going to happen. Quite how the market's going to react to the GDP, I'm not sure. They don't usually react all that much to GDP numbers because they're a bit historical. And I don't quite know what they're expecting because if it comes in at 5 and they're expecting 5.4, then they might.
I don't think anybody's expecting. Well, I don't think the consensus is 5.4, John.
No, it's not. I haven't actually looked at that, but I think most people are expecting 3 to 3.5. That sort of level. Yeah. So yeah, if it's stronger than that, then that would be a signal for bonds to sell off again.
Okay, and I guess there's a slight glimmer of hope that maybe investors will look through the number and think that this is the peak of this particular cycle. Correct?
Yeah, and as you and I have talked about before, we're so close to this 5% level, which is a big level. And maybe a lot of people
in the 10-year yield, yes,
in the 10-year US Treasury, and people may be saying, "Well, at 5%, I'm happy to buy it."
Okay.
So,
thank you, John. And then the outlook for that is again, it's going to be tricky. I think we're in for a very interesting 18 months here as the end of 2023 and all of 2024 comes through and the beginning of 2025. You've been talking about the housing cycle forever since I've known you. And I know it's one of those things that we've been watching to see exactly how it's going to pan out, both in the US, UK, and around the world. The notion that the Fed and other central banks may yet break things is difficult to dismiss. I know we're trying to because we're optimistic on shares in general and on the economy, and on a long-term view, we are optimistic. But it's going to be a tricky disengagement, it seems, from the rate hike cycles. Yeah.
Yeah, I mean, the key is inflation. The Fed is very worried that inflation will come down to 3 and stop, and 3 isn't good enough. They do want it at 2. And so if that happens, then it's going to be quite difficult. We'll also be running into an election year next year, which again makes things trickier.
Well, thank you everybody for joining us, and we'll be emailing out the recording link as usual. And if you have any questions later on, because I know every time I leave a webinar or conference, I usually have questions like 2 days later thinking, why didn't I ask that? Then please feel free to ask away. And we will get back to you. Ask us on email or give us a call, or you know how to reach us. Thank you very much, everybody.
Great. Thanks, Jerry.